The debt debate really it took over the banking crisis. The banking crisis is still happening, but the debate and the headline news that people are paying attention to just got taken over by politics. To the Wiggin Sessions. This week we have Scheidt, who is the investment director of the Essential Investor forum that we put together so that you could act on the advice that we give on the Wiggin Sessions. Zach has been a longtime friend of mine. He was hedge fund manager. And so when we talk to him today, we're going to talk about the investment advice that he's been giving to Essential Investor readers. So it's kind of a recap of what's happened in the last couple of weeks. I hope you enjoy it. And if you do enjoy it, I want you to recommend it to your peers or to your family or to your friends, because I think the work that we do in the Essential Investor is vital. It's called the Essential Investor for a reason. You get a lot of advice from a lot of different people, but there are specific things that you need to know before you put your money down. So let's get to it. Let's jam. The debt debate, the debt ceiling, I call it the debt default debate because they were debating how not to default on the obligations of the federal government. For me, the whole default debate has just been totally boring. It's so annoying. First of all, the idea of a debt ceiling is just kind of a farce anyway. Since 1960, they have had this debate 78 times, and each time they've raised it. It's like nobody in the markets was expecting that they would default. It would have been mayhem if they did. We haven't even gotten to that point yet, and they still haven't voted yet, so we don't know what's going to happen. But if they were to default on treasuries are meant to be the risk-free asset that underpins banks, and we already have a banking crisis underway. If they were to default, then treasury rates would have to rise. The interest rate to raise money for the government would have to rise dramatically. And that would take what is effectively a risk-free asset and turn it into an object of speculation, which would wreak havoc on the markets that are already skittish because of the Fed raising rates to combat inflation. But if you look at like the Dow and the S&P and the NASDAQ, they're all been kind of hanging around waiting for politicians to get their act together and make an announcement. There's only two things I'd like to note about the deal that they've been discussing today. Is the Republicans were trying to cut spending, but they ended up in the deal that passed. They ended up not cutting spending at all. They just didn't raise it for the 2023 income, and then they got some work requirements for food stamps. That's about all they managed to do. And on the Democratic side, they wanted to prevent a pipeline being made. It was going to extend from West Virginia to Virginia, and that's one of the riders that is probably going to go along to the Senate version. They're going to try to. The Republicans won with the support of Manchin, who's a Democrat in West Virginia. They were able to get approval and go right to the legal debate over it instead of going through the EPA on that pipeline. And Democrats they're going to try to rip that out before it goes to the Senate. So those are, I think, the two sticking points right now is the work requirements for food stamps and this pipeline from West Virginia to Virginia. I'm sure that Zach is going to have some other interesting perspectives. But the point I want to make is that the debt debate really it took over the banking crisis. The banking crisis is still happening, but the debate and the headline news that people are paying attention to just got taken over by politics. And what that did is it just slowed everything down. Like the markets weren't very interesting, except for that NVIDIA explosion with the AI chips, which we saw earlier this week. Nothing else has really been happening in the markets. So Zach, I'm gonna ask you what do you think? What do you think of the debt debate? I don't even really want to talk about it that much because it's there's not really anything. So maybe I'll ask a specific question. What do you think the impacts of a deal will have on the markets if they're able to get it out of the House today, send it over to the Senate, and then it'll probably take 2 or 3 days for the Senate to figure it out. But
yeah, I think it's really interesting to see how I do think something will get done. There's still a little bit of risk, but every hour that we go that the deal doesn't blow up makes it a little bit more certain that we're going to have something that is together. So I'm a little bit concerned about the overall stock market right now as the debt limit is passed, because I feel like we didn't get that much of a sell off. I feel like there was this sentiment in the overall market that we're going to get something done, and people were basically have already positioned themselves to profit when a debt deal gets done. And the thing that if you've been in the markets as long as I have, you know that when everybody believes something, you got to start worrying about what happens when they start to unwind their position. So if everybody's already bullish because they're expecting this debt ceiling deal to go through, everybody has already bought their shares, everybody is now positioned for this good thing to happen in the market, we're unlikely to get a pop when the good thing happens because people have already bought. And we are, in fact, more likely to see people take some profits off the table or even just some exposure off the table, which could drive stock prices lower. Another thing to consider is that once this debt ceiling is passed, Janet Yellen, the Treasury Secretary, has to sell something close to $600 billion worth of Treasury bills to basically put money back in the checking account of the federal government. So if we have $600 billion of something that's just waiting to be sold, I was on a call earlier today with some of my colleagues, and we're saying, where is this money going to come from? Who has $600 billion to buy all of these Treasury bills or Treasury bonds that are going to be issued? And the answer is it has to come from some other area of the financial markets. So does that mean people are going to be selling shares of NVIDIA, locking in profits, and using some of that cash to buy treasuries? Does it mean people are going to be selling the S&P 500 in general to be able to buy these treasuries? Will the Fed have to lower the price and raise the yield on the treasuries that it issues in order to attract new buyers? Probably so. And so there are going to be ripple effects that could be negative that go through the market once the deal is made, just because there's so much selling that's happening from the Treasury. So it'll be really interesting to watch how that works. And it's another reason why I think it's so important to have some cash in your investment account to take advantage of any pullbacks that we see, and B, to be diversified. And I apologize for that. To be diversified and to not be too far out on the risk spectrum. In other words, not to have too much exposure to the speculative stocks that have a lot of risk in them, because those names could come back, especially if we start to see the overall market roll over. Those are the names that people get fearful about and sell very quickly. So just because we get a debt deal this week doesn't mean that the all clear is sounded for investors. In fact, it creates a whole new set of risks. Obviously better than if we didn't pass a deal, but it does create some risks for investors.
Zach, let me ask you a question. So we've seen this each time that they debate the debt ceiling. Mm-hmm. Even after the deal is done, they have to raise the money to refill the coffers, as you pointed out. And sometimes it's way more aggressive than others. This one's going to have to be pretty aggressive because they waited as long as they did. Mm-hmm. They lower the price of treasuries because they have to attract buyers, and like mm-hmm. you're saying, somebody might sell some of their portion of S&P or NVIDIA or whatever, and move that money to to scoop up the lower price. And then at the same time, they have to raise yields, which means that it costs less to get into the deal and you get paid more for owning that bond. Which is, it can be a good thing for an investor to get a lower price to get in and a higher return on the other side. So the first part of my question, I'm going to let you answer both of them after I ask. It's a two-part question.
Okay.
Is there like a strike price that you like for treasuries, especially if, you know, we've got the banking crisis hanging out here in the wings. If there's still instability in the market, treasuries can be a good thing to own at a good price and a higher yield. So what would you be looking at to move in that direction? And then the second is, what is going to be the impact of the rising return, the interest rates, after they attract people to buy the treasuries in order to fulfill that 600 billion? What is going to be the impact of rising rates on the inflation argument and what the Fed is up to? So the first question is, do you have like a price in mind that you would want to see treasuries come down to? And then the second question is, what is going to be the impact of rising rates on this sort of macro picture we have with the Fed battling inflation?
Sure. So for the first part, there's not a specific price that I have pinpointed, and one of the big questions right now is which treasury bills or treasury bonds will Janet Yellen sell in order to raise this capital? So she could sell 6-month T-bills, which then they would have to refinance in 6 months. She could sell 1-year T-bills. She could sell 5-year bonds, 10-year bonds, 20-year bonds, or any combination thereof. And so one of the issues that we've got right now is that we've got an inverted yield curve, which means that shorter terms have a higher interest rate. So if she's going to sell 6-month T-bills, she's going to have to sell them at something like 5%, a little over 5%. And that means we're going to pay higher interest rates as a government. But we only have to pay those higher interest rates for a short period of time. And then we have the question of when, when that 6 months is up, what are the interest rates going to look like at that point in time? And then if she sells 10-year treasuries, the advantage here is that you have to pay a lower rate, probably I think somewhere in the 4.5. It changes on a day-to-day basis, but lower than what you would have to pay for short-term bonds. But the problem for Janet Yellen is that she's locking herself into paying that 4.5% yield or whatever it is for a 10-year period until those bonds mature. So it could be that interest rates move sharply lower over the next 3, 4, 5 years just because of the potential for recession and normalizing. But the Fed would be left paying a lot more in interest on those bonds over that long-term period. So it really is a challenge for Janet Yellen and her team to figure out what they want to sell. And then for us as investors to kind of say, all right, what area of the treasury bond market is going to get hit?
Just what the impact is going to be on the Fed's effort to tame inflation by raising interest rates. There's a lot of speculation in the press up until the debt ceiling took over the conversation, but there was a lot of speculation that the Fed was going to pause, or that later this year they might even drop a quarter point or something. I don't think that's they haven't tamed inflation yet, but
right. And I agree with you. I do not believe that's going to happen. I think that the Fed will have to hike either in June or July. But one thing that's very interesting about this whole debt selling dynamic is that Yellen will naturally push interest rates higher by selling treasury bonds. And that kind of does part of Jerome Powell's job for him, because Janet Yellen is using the actual market and not just the short-term market, but the long-term market for treasury bonds. She is raising interest rates by the fact that she's selling $600 billion worth of bonds into this market, which is exactly what Powell and his team are trying to do as well, raise interest rates to help slow down the economy. So I think this Treasury auction, the next few months of Treasury auctions, will in fact help to slow the economy, because it's doing the exact same thing that Jerome Powell is doing. And that is that's going to actually exacerbate the banking crisis as well. It's going to cause a ripple effect through financial markets, and specifically the way that that companies have to borrow, that individuals are borrowing money, what they're having to pay for those borrowings. And then, as I said earlier, just create competition for investment dollars, because now if investment dollars are coming into these treasury bonds, where are they coming out of? Does that make sense?
Yeah, I think we should pay attention too to the short. If she does 6 month or 1 year offerings, she would have to drop the price pretty dramatically, and that would just be like a big federal band-aid on the finances that she has to deal with right now. But it does present an opportunity. We leveraged our way into a pretty low mortgage rate on one of our properties in Maryland, and I think I don't know, we got, at one point we were 12 points above the lowest ever offered, which I was
12 basis points.
Yeah. So
Wow.
we were like, it was great, and we're locked in. I think 15 years on that one, but it's like I think it's like 272, and if we're borrowing at that rate, and we can still get, I don't know, if she has to pay 5 or 5.3 or something like that, then that is like a binary trade right there. You have low to borrow, but we're getting paid back on short-term loans. Like that's just
an arbitrage.
I've written, arbitrage. I've written that about that a couple times, just because those opportunities pop up, like when she has to raise the money to fit that $600 billion bill. We don't know what mechanism she's going to use, but she could be paying, I mean, even upwards to 5.5. And if you're borrowing at a lower rate, like a lot of us are,
Yeah.
it's a good.
So not to go on a complete rabbit trail with this, but it's interesting what you just said about your mortgage rate and thinking about how this affects the housing market. I've been watching housing stocks, and particularly home builder stocks, and the best fund to look at is ITB, which is the iShares U.S. Home Builder ETF. But one of the things that's going on in the market right now is people who have homes, who bought homes over the last 5, 10, 15 years. I think it's something like 60 to 65% of all borrowers have mortgages that are under 4.5% or under 4% or something like that. It's a huge number. And if you were going to get a mortgage right now, you'd have to pay 6 or 7%. And so what's happened is people do not want to sell their homes because, like you said, Addison, if you've got a mortgage and you could pay off your mortgage if you want to, but you can literally use that cash and get a 5 or a 6% return, but you're paying 3% on your mortgage. You absolutely should not ever pay off that mortgage. You should just go ahead and collect that extra 2% differential and continue to make money over and over and over. What's that?
I said, tell my wife that.
Well, it's true though. It's free money. If you do the math. Now, I understand there's some psychological issues about just paying off your debt and not having that, and that there's nothing wrong with paying off your debt. But if you can make 5% and you're borrowing at 3%, you should do that as much as you can. It makes financial sense. And so people who have homes with low mortgage rates do not want to sell their homes. They don't want to sell to move to another, to find a new job. They don't want to sell if they retire, even if they don't need the home anymore, because it just doesn't make sense. There's something that just makes you cringe if you're going to sell something, buy a new home, and you're going to pay, a 7% mortgage when you're already locked in at 3.5. And because there is not these existing homes are not going onto the market, there is a shortage of homes available, and that means that home builders who are putting up these new structures, they are able to sell at higher prices because there's just no inventory available. So even though mortgage rates are moving higher, which theoretically should be pushing home builder stocks lower, we've just seen a resilient bull market for home builder stocks, and they keep climbing higher. And it's an area that I've been watching really closely, and I think that's going to continue as long as these interest rates remain high, and as long as the economy stays relatively stable, and we're still there right now. You guys probably know by now that that I'm a little bit, I don't know if you want to call me a gold bug, but I do believe in owning gold long term as a stable storage of wealth. But I also believe in trading gold during specific opportunistic times when we should see the price of gold moving higher. There's a lot of reasons to love gold in today's market right now, which is why I want to have a more aggressive approach to gold right now. One of the reasons is simply because inflation is still out of control. Even though it has come back some, inflation, when you get a lower reading on inflation, it doesn't mean prices are coming down. It means prices are still going up. They're just not going up as fast as they were before. Prices are still going up much faster than the Fed's target 2%. And I don't see that that's going to come back to 2% anytime soon. So inflation is still out of control. And you want to own physical goods that hold their value during an inflationary period, which is gold. I mean, that's what gold is made for. That's the role that it plays in our financial market. So this is the perfect time to own gold. And the other thing is that we've seen the dollar start to pull back. And I'm pulling up the chart right now. DXY is a good kind of barometer for the US dollar compared to other currencies. And it peaked out in October of last year. I guess it was September, late September, early October that we really got that turn. And since then, the dollar has been making a series of lower highs and lower lows. It's bounced a little bit over the last month, just kind of the last 3 weeks or so. But in general, the dollar is trading lower. And when the dollar trades lower, it takes more dollars to buy stuff. So it takes more dollars to buy an ounce of gold, which is another way of saying the price of gold is moving higher. I do expect that the dollar could continue to trade lower simply because even though the dollar is kind of the world currency, it still is one of those areas where we have our share of challenges. We've got a weakening economy. We also have the potential for interest rates to move lower, probably not this year, but next year if we hit a recessionary environment. And so traders get ahead of these potential changes. And so we could see the dollar move lower because of that. Also, the fact that other currencies that compete for international investments, other currencies are strengthening to some degree. And that may be because other not investment banks, other central banks are raising their interest rates more aggressively than the Fed is. And also just because of the differential between different economies and how they're holding up. So the bottom line is that the dollar has been weak, which helps to propel gold higher. If you're all right, Addison, we'll go ahead and jump into the oil market because I do think that's an important area for us to look at. And I think it's an area of opportunity right now as we head into the summer driving season. And the oil has actually pulled back and gasoline prices have pulled back. And a big part of that is expectations of the potential for a recession, but also because the U.S. has been artificially pushing the price of oil lower by distributing barrels of oil from our strategic petroleum reserve, or as I like to call it, our strategic political reserve, because this whole distribution has been more of a political move than something that's a strategic emergency type of move for markets. So I'm not really happy as an American that our resources are being used to kind of help benefit one particular political party. But at the same time, we're traders, right? So we have to look at what's going on in the market and how do we take advantage of what's happening. Because I don't really have a whole lot of influence in Washington as to whether or not we're going to keep distributing these barrels of oil. So oil prices are lower because of concerns about demand and also because of these distributions from the SPR. But we're now at a point where the SPR is likely to be refilled, or at the very least, we're seeing these distributions dry up. Meanwhile, OPEC plus the cartel that really tries to manipulate, if you will, to manipulate prices of oil for their favor. They are setting up a meeting in the next couple of weeks that is expected to cut production And when you have less supply coming to the market, it naturally helps to boost the price of oil. So there's some catalysts on the horizon right now that could drive the price of oil higher. Meanwhile, we've got energy stocks that are trading at lower levels, and I think that there's a lot of opportunity to buy these stocks right now at lower prices and to see them move higher throughout the summer driving season, and as we have these supply demand dynamics start to shift back in favor of investors and higher prices. Natural gas is another area that is really interesting right now. Natural gas prices have pulled back quite a bit. And a big part of that is because we have too much supply. And that's because A, we can't export it fast enough to Europe. And B, just because we've had natural gas basically filling up our tanks here in the United States due to somewhat warmer than expected winter, both in Europe and the United States, and just less demand than we expected. I don't expect this whole low demand, high supply environment to last. And here's why. We've got several export terminals that are coming online over the next few months, which will make it easier for us to export natural gas to other parts of the world, which means it opens the U.S. up to more international demand, not just domestic demand. And the more that we can sell internationally, the higher the price will go, just because we have more buyers now to sell to. Natural gas is an interesting commodity because it's not really as easily transported as crude oil, but that's changing with new LNG terminals and so forth. And then the other thing is that we have just not enough electricity in the United States to match our goals as we move forward over the next 2, 3, 5, 10 years. And that's because we've got electric vehicles coming online. We've got these artificial intelligence computer chips that are just sapping up energy as fast as you can put electricity into these servers. We've got cryptocurrencies that are very energy intensive. The bottom line is we just don't have enough electricity on our grid to cover what we're going to need over the next several years. And natural gas is one of the very few clean burning fuels that we can use to generate the electricity that we need. So I'm expecting demand for natural gas here in the United States and around the world to really pick up.
Zach, let's. I've been following the oil price and some of our picks pretty closely because I think long term, especially with the climate change debate and all the money that's pouring into private equity because of things like COP26, COP27, there's trillions of dollars going into technological research to get climate, I don't know, everybody's got a word for it, but things that are climate friendly, hills and all that kind of stuff. But I just, it's not sustainable for us to expect to move off of fossil fuels and sustain our lifestyle anytime soon. And when you get pullbacks in either the oil or natural gas market, because it's summer, not as much energy, but the demand for energy is just going to keep going up. And it's going to probably take some kind of combination of fossil fuels and climate friendly. You can tell what my political view is on that, but it's going to take a combination of all of that. In the meantime, the market for fossil fuels is just going to be robust until forever. I think it's just going to keep going up and up and up.
Yeah, probably at least in our lifetimes. And one of the concerns and really frustrations that I have with the current administration is that there's just been so much signaling to the oil and gas industry that we hate you guys. Like, we think you guys are terrible. We don't want, we want to do away with oil. We want to do away with natural gas. And so that whole political argument has made it untenable for energy companies to continue to invest in new drilling, in new areas of resources. And if you don't replenish your resources, and if you're not given a financial incentive to replace your resources, there's going to be less and less and less supply available, and then that's going to drive the price higher. So this whole political thing about pointing fingers at oil companies and telling the American people that oil companies are being these rich, greedy companies that are hoarding profits is is absolutely not true. The issue is that we have made it economically unsustainable to be drilling for oil because there's so much uncertainty about what the regulatory issues are going to look like. And so we basically pushed these companies into a place where they can't invest in their own business. And so they have to use the cash that they're making right now to pay back shareholders, because that's what companies do. If you have a company, if you own a company, you want that company to make money and to pay you the cash, especially if they can't reasonably invest in new areas of opportunity. So the whole political issue has actually driven oil prices higher, natural gas prices higher, and by extension, a lot the price of transportation, the price of many other goods and services that we appreciate here in the United States. And yeah, not to beat a political drum, because I try to be as apolitical as possible and really focus on the investments and what the opportunities and the risks are that we have as investors. But this really is an important issue that's playing out, and I think we'll be studying this for years and years and years to come. If you make financial incentives against an industry, you can't then go back to this industry and say, "Oh, why aren't you doing the best that you can?" Well, the reason why is because you signaled very clearly that this industry would not be allowed to grow or to profit or to to make money over the long term. Just my 2 cents.
Yeah, what's your view on where we stand with the banking crisis?
Yeah. So right now,
I got to phrase this question properly. we were talking about raising interest rates so that the federal government can fund itself. The Fed is still battling inflation, and there's an upward pressure on treasuries, and treasuries are sort of the bedrock of, like, for example, Silicon Valley had more than half of their assets in treasuries, and when rates started rising because the Fed was pushing them up, that's what they did them in. And they have all these tech people taking their crypto profits off the table and yanking their money out of the bank. And then it only took 48 hours for Silicon Valley Bank to fall apart. And I think that the risk there, especially if we have rising treasury rates, the risk to a lot of other banks that we haven't even heard about yet is still hanging out there. We just haven't been talking about it. So maybe just give me an overview of where you think we are in the banking crisis, and then we can talk about Bank of America as well.
Yeah. So I think initially we had a flash explosion, right, with Silicon Valley Bank and a couple other high risk banks, and we saw this explosion take place, and everybody realized what the risk was, and the FDIC had to come in and say, well, we're going to implicitly, not explicitly, but we're going to implicitly guarantee that any depositors, that their money is going to be safe and make everybody whole. And so that helped to calm things down a little bit. But an analogy might be if you think of a battleship that had, like an aircraft carrier, and there's a bomb that was dropped on it. You see the explosion, right? And then it's really scary, and then the flames die down, and then you say, okay, wow, the worst is over, right? Well, that's not necessarily true, because the explosion actually caused a breach of the hull, and so while you look at the battleship from afar, it looks like it's just fine. There's actually water pouring into it, and it's sinking lower and lower and lower, and eventually the thing is going to sink. I think we're in that second stage for the banking crisis right now. So we're not going to see a giant explosion, or we may still see some aftershocks, but I don't think that we're going to see the same kind of explosion that we saw with Silicon Valley Bank, because the FDIC has made it clear that depositors are going to be made whole if a bank goes under. But we still have this issue of rising interest rates causes these treasury bonds to be worth less and less and less, which means that the banks, their collateral, their assets, the asset side of their balance sheet is becoming smaller and smaller, and that is a major problem. The other problem that I see is that businesses and individuals like you and I don't want to have too much capital in any one bank that they see as a possibility of going under. Even if you know the FDIC is going to make you whole, what happens if you don't have access to your capital for a week, 2 weeks, 3 weeks. If you're, and I think I used this analogy last time we talked, but if you're a small business that sells HVAC units, and you're heading into the summer right now, and people need to keep their homes cool, and you have orders for 500 HVAC units, and you've got to pay your staff to get them in place, and you need to have access to your cash. And if you go a week without having access to your cash, that could sink your business because you aren't able to meet your customers, and they're going to go to another competing firm, and you'll lose all of that business. And so if you're a smart business person, you say, I can't afford to even have the possibility of just, even if I know I'm going to get it eventually, if I have to go a week without getting my cash, that would sink me. So I'm going to put my cash in Bank of America. I'm going to put my cash in JP Morgan. I'm going to put my cash in Wells Fargo, because those are the big banks that I know won't go under. I'm taking my cash out of my regional bank because there could be a problem there, and I can't risk that problem.
Thank you for joining us for another session. We talked about Treasury bills, we talked about the oil market, we talked about gas, we talked about the war, we talked about a lot of things, and we're going to do that month by month as the investment markets unfold in the wake of the news cycle. That's what we do. If you'd like to get more information on what to do with your money, I encourage you to join the Essential Investor, because that's exactly where we put our own money. If you yourself want to take action on the advice that we give during our monthly recaps, then you should go to essentialinvestor.net. That's exactly where you can find the trades, not only in the model portfolio that we publish every month, but also the weekly trades. There are 2 conservative trades and there is 1 speculative trade, and we give those out every week. So if you're interested in those, then please become a member of the Essential Investor community, which is at essentialinvestor.net.